Hey everybody, this is Rob Gaines of goldsilverpros.com. It is July 9th, 2021 when we're recording this, and I'm here with Dave Kranzler of Investment Research Dynamics, here to talk about the Fed's potential stance for the rest of 2021. Before we get into that, I wanted to bring you the sponsor of this video. It is Sailfish Royalty Corp. They hold precious metal streams and royalties in the Americas, both gold and silver, and they have streams in different areas in Central, North, and South America, as shown on the table here, including several at Spring Valley, Moonlight, Gavilantes, La Cigarra, El Campas, San Albino, and the last one, I'm not even going to try to say it, in Brazil, a collection of gold and silver focused royalties. And one of the reasons why we like the royalty companies and Sailfish in particular is because they do perform better on average over time than some of the mining stocks. You may not get quite as much upside, but you get a little bit more assurance that you're not going to have to deal with the downside of some of the stocks. All right, with that being said, David, how are you doing today?
Not too bad. Thanks for having me on again. It's good to see you other than on the Chris Marcus organized podcast.
Right. It's been a while since you and I had a video. I know that you came to the conference last year. I think we've spoken once or twice since then. So I wanted to have you on the program. And you brought up an interesting topic prior to starting the recording, and it was the Fed and a recent announcement by the Fed about what they may do should they see some evidence in the economy about where we're going. Do you want to talk about that?
Sure. I mean, I've been saying all along that I didn't think the Fed was going to actually taper or raise rates. I think they've painted themselves into a corner. If they were to stop, so they're printing 80 billion a month that is used to buy treasuries and 40 billion a month. And it's at least. No one points out that it says at least in the policy statement. So it means they could print more than 120 billion a month. And 40 billion is going into the mortgage market. And if they stopped printing, let's just say they stopped printing, or even taper, not really take money out of the system, not do reverse QE or reverse, whatever they call it. I think you'd see a massive stock market accident and financial assets accident. So, and they know that. And when you think about it, the foundation of our entire financial system and really the economic system is based on the stock market being in a bubble. And if they take that away, I mean, at the bottom level, the value of the equity supports all the debt that's been issued and all the people don't even think about the derivatives when they're talking about how radioactive our entire financial system is. And just conveniently leave that out. But that'll magnify the problems if the Fed were to raise rates and start to taper or stop printing money and the stock market. I mean, I think we'd see just for starters, a very abrupt 20% sell-off in the stock market. So, but the reason why I wanted to bring this up is there was a report out, the headline report was that it said the Fed is prepared to adjust its stance of monetary policy as appropriate if risks emerge. Now, notice they're referring they're not saying, if inflation tapers and the economy continues to improve, which we know it isn't, if risks emerge. So, I mean, what that means is tapering isn't necessarily really even on the table. And I like the way they refer to the potential for tapering. Well, we're discussing whether or not to discuss whether we should taper, It's like, could you be, any more obtuse in how you're presenting this idea that you're jawboning, this idea that you're going to tighten the monetary policy because everyone knows inflation is raging, and they're not going to do it. And they're, so the reference to, well, we may start having conversations about tapering at a future meeting, that's just jawboning to try and support the dollar and keep appetite up for, especially among foreigners, if they can, for treasury bonds. Because at some point in the second half of this year, the government's going to have to start issuing a lot more treasury paper. And if if the Fed continues to buy most of it, I think they've bought something like,
Mhm.
I know it's over 50% of all treasuries since April 2020.
Yep.
I think it might even be higher than that. So, I mean, if the Fed is forced to continue being the primary source funding the treasury issuance, and obviously it does so by printing money, it's going to have to continue to print money.
Mhm.
or the market itself will take rates well over 2% very quickly.
Yeah. You mentioned inflation there. What had happened, I guess, for most of the last 10 years, at least if you follow government numbers and if you trust them, that's debatable. Well, let's just use the government numbers. Let's just use the government numbers as they are and just say, we'll just hold that and say we have some amount of faith. A lot of the money printing went to things like the stock market, real estate, and that generally, to some extent, benefits investors. But now we're seeing it creep into commodities. We've seen that since the beginning of the year. It's starting to creep into prices. It's starting to creep into rents. These are not really assets. These are costs for people. And it's starting to cause the middle class to really struggle. And the lower class has already been struggling. So are we at a point at which they can't hold the inflating genie in the bottle? Do you think that it's going to burst at some point this year? We're hearing some rumors. I want to get your take on that. Are we finally in that period of transparent high inflation from the government, or do you think even if we have it, they're going to try to tamp it down somehow?
Again, we're talking in the Alice in Wonderland world where we're putting faith in the CPI. So the rumors, as far as I know, because I saw some various tweets on Twitter, rumors supposedly came from an employee at the BLS. That was my understanding. And well, first of all, I find it hard to believe that employees, rank and file at the BLS see these numbers and they're not due out until what, Tuesday? I would be surprised that these people are allowed to see the numbers before they're actually due out, because if they do, why would this just be the first time that, the numbers have leaked out to the public ahead of time?
Right.
The tweet said the CPI is going to show double-digit inflation.
Yeah.
So to me, the source was vague. I don't believe the rumors. I don't believe the source of the rumors. Is it possible? Sure. But the problem, it creates a real problem for the Federal Reserve if they allowed a CPI report out that showed 10% inflation.
Yeah, wouldn't it panic the market and wouldn't it crash treasuries and
I think,
affect the dollar?
yeah, I think it would do a lot of things, but it would also force their hand on at least raising rates, maybe not tapering, but it would force their hands on that. Unless they think that they can continue convincing people that this inflation is transitory. And contrary to that, it's not going to be transitory as long as they continue printing money like they're printing.
Yeah. I'm wondering if the BLS contact with somebody may have been somewhat higher up and saw, because you have to run the algorithm, right? You run the algorithm, then you make your adjustments down to do the dog and pony, right? To say, well, everything's not as bad as we think it is. But at some point, they have to run the real numbers according to their algorithm. And even though the CPI has been bastardized many times over, when real prices do rise, there's only so much hedonics and geometric weighting and substitution that you can do before even that index breaks. So at some point, I think that they're going to have to completely obliterate the CPI formula and change it. Maybe they're doing that now and they just haven't announced it. But it's funny though, at the same time that announcement came out, I've had people emailing me and calling me right and left saying prices are exploding everywhere. And so I really get my data from the industry and they're exploding. So I know they're much higher. I had people in real estate saying my costs have gone bonkers. I know people in the commodity sector who say, and even in the mining sector who say, yeah, our costs are really high. So I expect the mining sector to should start reporting higher all-in sustaining costs. Whether they do or not will be interesting. But inflation's here. How long can they fudge this number before Sally Homemaker, who actually has to pay the bills, says, screw you, I don't believe anything you say, and actually changes their behavior to deal with inflation?
I think based on what I've been reading, it sounds like at this point, the retail segment of the chain, of the food chain, so to speak, hasn't fully passed on the costs to the public. And at the same time, also wholesalers, are eating some of the costs themselves also. So, I think we've seen not very little, but a small portion of the inflation that you're seeing at the base input level. I think we're only seeing a portion of that at the end user level at this point.
Okay.
And I think what's going to happen here, on the assumption that price inflation is not transitory, and I just don't see how it will be, we're going to start seeing much higher prices in the second half of this year at the end user level. We're already seeing it at the gasoline pump.
Yeah.
I mean, I paid, for the first time in years, I paid over $4 a gallon this past weekend. And I know part of it had to do with it being, well, I have to use 91 octane, but part of it, obviously they jacked the price on long holiday weekends, but I was at the pump a couple of days ago, and it was still it was under $4, but still pretty close to $4 for the highest octane that they sell in Colorado anyway.
We live in an oil rich state here in Texas, and we have the refinery, so we usually are a bit cheaper than a lot of other places, and we've seen it get to about $3. But my goodness, 4 is that's a pretty.
I was reading reports like in Southern California, it was over $5 a gallon last weekend. Yeah. And I guarantee you, if I drove up to Aspen, it would have been over $5 a gallon. So, and I have noticed just recently that, I often get takeout from a handful of the same places. You find places that are good and you stick with them. And I've noticed that prices are starting to go up a little more quickly at restaurants. And I've also, I do a lot of the grocery shopping for our household. I've also noticed that prices at the grocery store are starting to move higher, or packages are being shrunk smaller, which is, the sneaky way to pass on the cost of inflation. So I think you're right. I think that they've probably already done a lot of the things that they can do to mute that, to make sure the CPI mutes the real inflation rate. But it just seems to me like, just when you think the government can't pull another rabbit out of the hat, another rabbit appears. So in terms of this next CPI report, I'll be surprised if it shows anything even close to 10% price inflation.
Okay. So I agree with you. And this tends to be a very long tail process, because you have interests that their incentive is basically to keep lying at this point. I think government doesn't want to go away. It's become its own monster in a way, and it needs to continue to feed itself. So the lesson there is be careful, what you trust coming from government. Wanted to switch over to gold and silver. I've had a lot of subscribers coming to me lately who've been following gold and silver for a long time, and they're still supporting gold and silver. They still understand the long game, but they're getting disillusioned with how long this last stage of the manipulation has been going on. I think most people have felt like gold should have, launched off the pad by now. It hasn't. What are you telling people as to, staying patient? Because personally, I think we're near the end, but I don't know what your thoughts are. But what are you getting from your subscribers?
That's a good question. It's an interesting question. I think the people who are most frustrated with this sector, well, first let me back up. And we talked about these numbers a little bit before we started recording. And I jumped into the sector kind of early, mid 2001.
Mm-hmm.
I was kind of dragged into it by a trading colleague. I was still busy shorting tech stocks back then. And he finally got me to look at the sector, and I was looking at it. And I would spend 12 hours a day researching back then. I was like, holy crap, this thing's going to be explosive.
Mm-hmm.
Well, back then, at one point, when I first started, gold was like, getting close to 300. And at one point it actually had traded briefly back down to 250. And so at any rate, what I did is I looked at some numbers, and my measurement period, because it's debatable exactly when the 1980 bear market in the precious metals sector ended and when the current secular bull market that we're in began. Mm-hmm. But it's 2000 or 2001. Let's split the difference. Let's say 12/31 2000 is when it ended. So that was my measurement period, because you have to choose a measurement period. And it wasn't calculated to show, the best entry point for gold and the best entry point for the stock market back then. Obviously the stock market was on its ass at that point, so it was probably a good time to enter the stock market, and the same thing with the precious metals. But since the end of 2000, here's the returns. Gold's up 720%, silver's up 650%, the Nasdaq's up 594%, and these are through this morning. The Dow's up 323%, and the S&P's up 300%. Mm-hmm. And I'm guessing, if you just started doing the stock market in the middle of March 2000, you'd be surprised that those are the numbers over the last 20 years. Mm-hmm. Those are the numbers. And so I guess my point is, 20 years is a long period of time, but if you had just taken your portfolio, say, and put, evenly distributed amongst gold, silver, and the three major stock indices, ETFs, gold and silver have handily outperformed the stock market in that time period. So, the intervention is oppressive, and in the context of a short period of time, it feels like it'll never end. But clearly those numbers tell you the best they can do is hope to break the rate of ascent for gold and silver. They can't ultimately control the rise of it. And so I've noticed with my own subscriber base, when usually, like, when the market starts to run up, I get, a rush of new subscribers. And then when we get into, a 3 to 6 month period like we're in now, I get a lot of subscribers who cancel. And I would bet 90% of the cancellations I've had in the last 6 months have come from people who subscribed starting in April 2020. And so I think a lot of people who get frustrated have been unfortunate to maybe start deploying their capital in the sector after the sector has had, a fair amount of, a pretty good run higher. And so it's just an unfortunate point of entry. And I always tell my subscribers, I'm like anal about this. Look, don't chase the market. Here's an idea that I like. If you like the idea, I don't know if now's a good time to buy or not. I just know I think a year or two from now, it's going to be a lot higher than it is now. Buy a little now. And if the market sells off and takes this stock lower, then you have capital to buy even more. And that's kind of, that's just rational investing in anything, not just this sector. But this sector tends to be volatile because of the degree of intervention. And so, you got to be a little more prudent about when you deploy your capital, remove some after a big run up. I get these guys who ask me questions about a stock that's, a junior miner that's gone up 500% in 3 months or 4 months. And they're like, I don't know if I should hold or buy more or what. I'm like, are you crazy? Take half your money off the table. Take 2/3 of it. This stock's going to pull back. And then if you still like it after it pulls back, you can buy even more because you'll have more money to buy it. So, And in my fund, over the last 2 weeks, I've gone from about 8% cash up to over 20% cash, because I kind of smelled what's happened over the last week coming. And part of my rationale was, a lot of times, and you can go back and look at the charts, the last couple big stock market sell-offs we've had were led by the housing stocks, the home builder stocks, precious metal sector, and the cryptos. And if you go look at a chart of just the Dow Jones Home Construction Index, it's in a downtrend. It's not, I don't think it's down 10% yet, but the last time I looked at it, it was getting pretty close to correction territory. Obviously, the cryptos have been getting hammered, and obviously the mining stocks have been getting hammered. So I think there's a good chance that this is a precursor to a potential stock market accident.
Yeah, that would be really big news. Want to turn attention real quick, last segment of the interview, to talk about all these storage programs. So this has been a super hot topic for us. I don't know how many emails I've gotten over it. Of course, Daniel and I did some work on the Perth Mint, looked at their financials. So, but it's just received so much attention. As people are considering how to get into gold and silver, a lot of people want the convenience of someone else securing it and providing custodianship for them. So they may go to Perth Mint, or they may go to Kitco, or they may go to any of these storage places that ultimately use Brinks or Loomis or one of those to put their gold and silver. I wanted to get your thoughts on what's going on here. Does any of this, in terms of the unallocated accounts, the pooled accounts, and people having trouble actually getting the physical when they request it, does any of this surprise you? Have you seen this before? And did you expect this to happen? Well, there's an evil laugh.
Gotta open up that viper's nest, huh?
Yeah.
I'll start with a story. It was probably the summer of 2011. I had a tennis match, a competitive tennis match, and the guy, in between sets, we were just chatting, asked me what I do, blah blah blah, and he said, "Oh, I've got some gold." "Oh, really? You own physical gold?" He goes, "No, I got GLD." Mm-hmm. And I just said, yeah, that's not really owning gold. Mm-hmm. So I recall probably, when I first jumped into the sector, and there was the real hardcore gold bugs back then, and a lot of them have kind of disappeared. It's not that they've passed away, or they've moved on to different sectors. A lot of them have just kind of gone off the grid.
Yeah.
And
there could be a reason for that, by the way.
Oh, no question about it. And
I'm not being public about it at this stage.
I think I was reading an article from Eric DeCarbonneau. I don't know if you've ever read his stuff. Mm-hmm. Apparently, he's a descendant of the Vanderbilts.
Oh, wow. I didn't know that.
Yeah. So, I think it was him, and whoever it was talking about, you don't own your gold, your physical gold and silver, unless you have it in your possession. Mm-hmm. And that's the only way you're going to get the full benefits of it. Mm-hmm. At the time this article was published, GLD didn't exist yet, but all of these unallocated storage programs, Kitco and Perth Mint, their programs have been unallocated going back to when I was first started in the sector. And it was a big topic of discussion then. Monex has a product. They actually, I think, got in a little bit of trouble with their product, and I think they still have it. I think it's called Apollo account or something. I forget. They may have changed the name. So at any rate, but the debate was, look, if you, with physical gold and silver, possession is 100% of the law. Mm-hmm. Either you hold it or you don't. And if you leave it in someone else's custodianship, you risk not ever being able to take possession of that metal. And that's, we're seeing that. We were seeing it back then. People had those issues. And now obviously we're seeing it now, and in a bigger way, because guys like you and that John Adams guy are exposing this stuff. Mm-hmm. So my feeling is, unless you're a billionaire, if you've got $500,000 or $1 million that you want to put into precious metals, I mean, why would you buy the metals and then let someone else hold that? That it's not even a bank where it's guaranteed. You're giving your $1 million or $500,000 to someone of your wealth to hold, presumably in gold and silver, and there's no guarantee that you'll ever get it back. But, I mean, does Kitco have fine print that says we guarantee that if you call us up and you want your gold and silver, we'll send it to you? No. I don't think they do.
No.
Right. And so, I mean, and here's the other thing. So if you buy an ETF like GLD or SLV or whatever, fill in the blank, or you use one of these unallocated storage programs, Kitco, Perth Mint, you will get the benefit of indexing the gold and silver price. But I would bet 99% of the people who invest in those things never intend to take delivery anyway. And that's what they're exploiting. That's what the COMEX exploits. And so when you sell your investment in these programs, what's your settlement proceeds? It's not gold and silver. It's fiat currency. Fiat currency that's being devalued every day. The Fed's printing $4 billion of new currency every day. So, I mean, and I don't know if even owning physical gold and silver is going to, save us from what's coming if we live long enough to see, the end game of what's going on. But holding that versus holding fiat currency is at least going to give you a chance, right?
Right.
So, I mean, I like to use the Weimar Germany example, right? So I think it was, I forget the exact dates. I think November 13th, guys back then who were the back then equivalent of multimillionaires and billionaires, and they had their money in the bank, went to bed, and they woke up on the 14th, and I think it was a 1 for 1 billion reset.
Yeah.
Of marks. So
they were broke at that point. They lost everything.
Yeah. And people who had gold, because gold went to the moon, people who held physical gold in their possession, they were unscathed. I mean, obviously, you got to deal with your surroundings and your environment around you. And that all of a sudden goes from functioning to third world overnight. But you're at least, you've preserved your wealth. And that's why it's important to, I mean, if you want to screw around with those gold investment accounts or the ETFs, that's fine, and use it as an indexing tool, as long as you know what you're investing in. You're not investing in actual physical gold and silver unless you actually hold it. And that's the only way to get the full intended benefits of holding physical gold and silver. And so that's where I come out on the issue.
Gotcha.
And people who want to, pardon me?
No, go ahead.
People who want to put their money into gold and silver for the purpose of realizing the benefits of holding it, you need to hold the physical gold and silver. If you got 250,000, 500,000 that you put into gold and silver, it doesn't take up that much space in your closet or your basement, and you can hide it. It's not like, what are the odds that your house is going to get robbed? You have a better chance of driving on a freeway and getting into an accident than having your house robbed, right? So I wouldn't worry about, and then you also don't pay the costs of storage. The cost of storage something that may actually not be there. And Morgan Stanley was nailed for doing that, I believe.
2007.
There you go. Yeah, I've always been so long since I've read that story or became familiar with it that I forgot the exact dates. But right, so they were nailed for selling silver accounts to people, and the silver wasn't in the account.
And they defended themselves by saying, well, we're following industry standard practices. And
that's right.
That was part of the lawsuit. David Morgan, we just interviewed him the other day. He actually had one of the articles talking about that, the news report. And the news report said Morgan Stanley defended itself by saying this is what everybody does. And the judge bought off on it, and they were able to settle, without getting a conviction because, well, that's what everybody does.
Isn't that amazing? People don't believe that the bullion market is fractionalized and that there's not manipulation. And yet here is a Wall Street investment bank admitting that that's what it is.
Exactly right. It's crazy times. And I agree with you mostly for the most part. If you don't hold it, you don't hold it. I think there are probably safe places to put it, but you have to be super careful. And I agree with you. If overnight we have that sort of crash in the financial system, even if you trust your storage provider, somehow conveniently that gold or silver could disappear, because think about what it's going to be worth. So one thing to say I have $50,000 stored in gold and silver, but if it resets to 5 million, somebody may pocket that and walk off with it and take their chances with the law, I would assume.
Well, that's the thing. I mean, all through history, when a country invades another country and they win, the first thing they do is they take the gold.
Germany did that all during, the Second World War. They would go after people's gold.
Right. Well, and that's how we ended up with Germany's gold. They were worried Russia was going to invade Germany and take their gold. And look at what we did when we went into Libya, Iraq, Ukraine. The first thing we did when we got control of the country is we took their gold.
Yeah.
And this goes back to Roman times. I mean, there's a HBO series called Rome, and early in the first season, it's two seasons. If you haven't seen it, you got to watch it. It's phenomenal.
Okay.
But early in the first season, it shows when Caesar's coming back from conquering Gaul, and one of the highlight features of his trip back is the fact that he's taken all their gold with him, and he's going back to Rome, and that's his source of power, is the fact that he has all that gold. So and like you said, Nazis, they would go into every country and take it over and take their gold. And so why do people think that that's not going to happen just because you keep your gold or silver in a depository in the United States? That depository, when things get really bad, there's a chance that depository is going to get ransacked. And when you call them up to say, hey, can you send me my gold and silver? And they're going to say, we don't have it. Sorry.
Yeah. And let's see.
Here, we got insurance. Here's our insurance.
Let's see if all the insurance providers even pay off at that point, right?
They may not. You're right. Yeah.
All right, Dave, you run Investment Research Dynamics. I'm going to put it up here on the screen. Kindly tell people how they can get in contact with you if they're interested in either of your journals here.
Sure. The website's investmentresearchdynamics.com. And those two boxes at the top, Mining Stock Journal and Short Sellers Journal, are links that give you more information about my newsletters and the costs. And I mean, each there's not a beyond the first month, there's not a time commitment. So occasionally I get people who will subscribe, get the back issues, and then cancel. But it's all laid out there. So the Mining Stock Journal, I publish every 2 weeks. The last issue I went out yesterday, and the Short Sellers Journal is a weekly.
Awesome. All right. Well, thank you, Dave, so much for being on the program. We'll have you again to talk more about the Fed. In fact, as things heat up in the second half of the year, which I suspect they will, I'd like to have you back on, and let's go back and revisit our thoughts on this one.
Appreciate that, Rob. Thanks for having me on again.
Absolutely. All right. You can find him on Twitter on investmentresearchdynamics.com. It is the awesome Dave Kranzler. Till next time, this is Rob with Gold Silver Pros.